All right, well let's get rolling here. It's for those that might watch this on a recording. It's May, what is it, Woj? 19th? Yeah, May 19th. Woj, who spends about once a month of his time with us going over Treasury. He's a spreader, but he uh, he understands all markets and talks about the interconnectedness of all these markets. And with the price action that we've had over the last few weeks in Treasuries, notably the Bund, he's going to cover some of that. Um, Instead of just going into Q&A, first thing, Woj, when did you started? I remember I started April 24th, 2000. So almost exactly 15 years. You started like 2 weeks after me, didn't you?
Right, we came in roughly the same time.
So it's 15 years that we've been doing this. And I was thinking, man, I took a recording and I got to show you. I haven't showed anybody yet. But remember when I used to have that little tripod on my desk and one of those cameras? Do you remember
Yeah,
that?
it was real grainy. Yeah.
Yeah, and I got it, and it happened. I happened to record the session where they cut the Fed when the Fed had a surprise rate cut in I think April of '01. I want to say the date's on there, and Scott announces it. And Scott, for you guys that don't know, would be like a human trade the news or rant squawk, where he'd have Bloomberg and other news sources, and he'd read anything that came down the wire, squawk it out to the office, and that was a big. I mean, the biggest event up to that point in probably our trading career. And they had a surprise rate cut, which is extremely bullish for stocks. And I bought 16 Euro stocks, which back then is big size, right? Because it was only 10 up generally that market. I got to show it to you though. I think you'll laugh. I think it was still on Yes Trader. Did they start you on Yes Trader?
No, I went to TT. They just introduced the ladder system to TT.
Yeah.
I think I was
Well,
one of the first few guys to ever do it.
and I think I was on TT also, but it was the book. I didn't go to the ladder for a while. I had a tough time. Not a tough time. I just didn't want to make the transition. All right, but that aside, I probably with the questions I got, you'll probably cover it with some of the first things you're going to talk about. So why don't you just roll with the way you were going to start, and then we'll just go from there.
So I'm sure there's a lot of equity guys and maybe oil. I mean, whatever you're trading, you can relate to the moves you're going to see in the 10-year German Bund is on the right of my screen, and then we have the U.S. 10-year note. They're relatively the same duration. Um, Risk-wise, sure some of you guys have heard that 10-year yields were almost negative. They got down to 5 basis points, and if you can imagine borrowing a 10-year note and actually having to pay uh, to give your money to somebody is absurd. So at the top of this, the peak. This is a daily chart for reference's sake right now. We've come off an enormous amount in a very quick period of time. And I remember when it happened, it was this bar here. It was this bar here. What happened was at 2 a.m. the Riksbank came out and said they were supposed to do a rate hike or rate cut, and they didn't do it. So if anybody wants to go back and see what happened on uh, April 29th, that's what happened, and that's what started the sell-off and the boom. It was just a kind of like it needed to happen for so long, and that was the catalyst that started this down move in the boom or in European bonds. And luckily, we followed them. On my left screen is the U.S. Treasuries, and one for one every day we're trending lower. The thing about what happened in the U.S. markets is, I don't know if some of you guys heard, but since that date, there's been an enormous amount of corporate bonds being sold to dealers. The dealers sell them to their customers. Um, when they sell these corporate bonds, they're actually buying them. Let's say Apple has to sell 20 billion corporate bonds. So you want to sell in all durations from 2 years all the way up to 30 years. So then the dealers buy these from Apple. Well, they don't want to get stuck, with a spread of what they have to pay Apple and then where they could hedge these off. So they immediately just start hammering treasuries until they're hedged of 20 billion worth of treasuries. They can go in all asset classes. They do it in uh, mortgage-backed securities. They do it in equities. They're just trying to cover the amount of their spread that they're going to sell to the customer. So once that deal is sold or traded to their customers, they reverse these treasury positions that they have. They'll actually go buy them back the next few days. It's called rate locking. You guys can go look up that term and see how it applies to corporate issuance after the deals are done. Um, it's, it's a really big thing right now with where rates are at. So um, this entire move in U.S. Treasuries is all based on a continuation of where the boons were at and what the boons are doing and the amount of corporate issuance coming through to the U.S. side. I think it's one of the first few times in months that I've seen the U.S. Treasuries and the boon correlate so highly. I know I was in a session a few months ago, and someone asked, how are they relating? And I said, well, we're in two different rate cycles. We're about ready to hike rates, and they're pumping as much money in QE and cutting rates as they can in Germany. So, having said that, it was really some of the best trading I've seen all year. And prior to that, for the past 6 weeks, it was some of the worst trading I'd seen. So this sell-off, I didn't catch the sell-off. It's not why I made money. It was just that things were correlating, and the concept of the way the market was moving seemed like it was, back in the old days. So I have a couple points where I made a couple trades. These are real trades. I put them on and I lost money in them, or I made money in them. And give me a second to pull it up. I got to go to let's see, May 7th. So this is way after the big sell-off. I'll go to if you guys have any questions while I'm fumbling around trying to get
No,
this.
that's all right.
You
That's
know what I mean?
that big expected rate cut that didn't happen. That was on the 29th of April, right? Was that, were
Right.
you in front of your machine or in front of your screens for that?
I was, yeah. I didn't expect the sell-off that happened. I'll tell you that. I mean, I was blown away by the just hand over fist selling. I was like, oh, this is exactly what happens when the markets make a dramatic turn, and it's hard to catch. But
Right. Man, they stepped all over it. Well, those are dailies, right? On the right side, the
on
boom
the
chart.
right, that's
Yeah.
yeah.
And by the way, Woj is the first guy to introduce different color backgrounds to charts. And you were black first, right? And it was
Yeah.
because it's softer on your eyes than the white, and then gray is like in between. I stayed darker, but you were the first guy that had different backgrounds on his charts. Not that you invented it, but you pioneered it.
Okay, we're on the 7th of May on the left chart, and that's kind of like, here we go. So you can see let's make this chart over here 60 minutes, so it's somewhat relatable. There we go. The idea was after these sell-offs, this is days and days of corporate issuance, and we're coming into Thursday. The 7th is Thursday, I believe.
And just so you guys know, Woj, I don't mean to interrupt you, but the vertical line on each chart is showing you the exact time of what's going on in the Bund. On the right is what's going on in the 10-year on the left. Some people may or may not know that. Go ahead.
Okay. So this is around the time that Germany opens up at 1 o'clock on my screen here with the Treasury with the 10 year. It's 2 o'clock, and I'm thinking okay, so for 3 days we had amount of corporations that if you look on the right screen you can see we kept selling off. This is now going into the second week of that sell-off, and I never faded it once, just on the base fact that you can't get in front of these guys covering their bonds. I mean, they have billions and billions to sell. So it was a difficult time for me, but I was able to avoid the real big down moves, which a lot of guys, they think, okay, corporations is not that big of a deal. Let's fade this. It just sold off another handle. And it wasn't really working out for them. So the way I made money on that was by not losing it, to be honest with you. Pick my spots a lot better. But this is 1 in the morning. I thought, that's it. It's Thursday. There's no more issuance for the week. We just, I had a strong conviction of, like, we're going to go up. We had a nice base. Let's see if I could pull this over here. See how we base over here for hours. All this is a low of a move. And when Europe opened up at 1 o'clock, I started getting into the spreads that were to capture a rising bond trend. So I was short a bunch of fights. You sell a 5-year, you buy the 10-year. If we go up, the way I had it weighted also is I would have made money. By 2 o'clock, I noticed the boons aren't acting like they should be. See, this 1 o'clock, you have a big red bar. 2 o'clock, the cash markets open up, and when that happens, that's the true tell-all for me of, like, what the direction's going to be for the rest of the European session until the U.S. opens up. And when they can't catch a bid, I lost about, I took 3 or 4 shots at getting long, the long end, some ultra bonds or some bonds versus, closer end duration, 5s and 10s. And I lost every time. Up until that point, I was up pretty good dough. I was right in my thinking, and then when the European cash market opened up, it just proved me wrong. And I quit trading because I couldn't really believe that they were going to keep selling this thing. And I was frustrated. I was angry. I was like, forget it. I mean, I'm done. I was maybe down a few bucks on the day, and I let the market chop around. And I got lucky in the sense that evening I was away from my screen. I went to the gym around 3:30 in the morning, and was coming back to the office, and I noticed I had about 40 phone calls that this market had happened right here. I mean, this was the capitulation of 8, 9 trading days of selling off. This was everybody puking. And one thing I want to say to you guys is what I've noticed in terms of market volatility, the faster a market moves an extreme amount, in my opinion, you're going to have a retracement just as fast. I mean, it's really rare that, you get a major sell-off. That's 126, 127 down to, that's 2 handles. That's almost 2 handles in the 10-year. I mean, that's like 4 handles in the ultra bond. That's 200 ticks in the bottom. It's a ton of ticks. It's a huge move. So I waited until this consolidation happened, where this bounce, this low here, rallied, and we got the first green bar. This isn't a rule or anything that I use. I just saw something in the market where it looked like a lot of buyers kept coming in, and the green bar proved it right because I think I was getting long here. And I was able to ride a lot of this up in a spread, so it's not like you're taking out that many ticks out of it, but it's a safe way to ride a long position.
Hey, Woj, can I interrupt you
That
one
was one of
second?
them. Yeah, go ahead.
So, I mean, you're dead on with a big capitulation move lower usually has a high probability of retracing. And the logic, and Woj knows this, but I'll explain it, is you finally, with a capitulation move lower, you finally get that synergy or that everyone who's long fighting it finally says uncle, 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 and then it's a self-fulfilling prophecy, and it's a confluence of other time frame longs also having to puke it because their stops are getting set off, and then it just whooshes lower, and you shake out any last long in that product. And as you guys know, less longs equals less sellers above the market now because they just sold and created that capitulation. So when there's less sellers, it's usually easier to retrace a down move is because there's less offers in the book to have to navigate through. So if in any capitulation event that Wodry have traded through, if you don't catch the sell off, you're looking to catch the bounce on it. It's either you're trying to catch the sell off, but at some point you're like in fade mode. If you're smart, you wait for a little like he did a consolidation so you don't get run over and get shook out and then end up being right. But you wait for that pause and then another place where the shorts are now wrong. But that's well said when high probability of capitulate, like the flash crash even. It sold
Right.
off for a different reason. It was going to bounce though because prices just get too unfair as that goes. But I like the way you put that because that's why we've always faded those. Even a spike, or a rumor getting dispelled or something like that. But
Well, if you think about what starts the capitulation, you don't know until it's too late. I mean, the chart on my left is still part of that, that's big bang into the lows. I mean, that happens so fast that unless you're catching it right away, like unless you're selling it through these lows, unless you're selling it through there and holding it, usually you sell it and you make a few ticks, you're like, woohoo! You're not expecting the follow through that comes. So my powder is so dry when this is happening, and I'm thinking at some point this is going to be a great opportunity because we know everybody's caught. We know they're out of the market now, and it's not supposed to have happened. It shook out all the longs. I mean, everybody like me that was bracing themselves for no more supply coming in just got destroyed. So I was lucky enough to not have a position on and not get hurt, but instead of, like I said, I was able to capture the market because I've seen this so many times now that my game plan is not to try and catch the bottom because I really don't know where it looks terrible. I mean, it looks scary as hell. You had no idea where the bottom was going to happen until these bars to the right of it. These are now 30-minute bars, and you have a lot of time to be patient. And if you're right, at least it pays you to be patient. Yeah, I mean, I don't know how you catch, capitulating sell-offs or rallies. I mean,
the only way you
it
catch
usually
them
happens
is
without any news either. There's no
right.
news that would give you a signal. It's not like he said we just hiked rates and then we
Right.
sell off.
I was going to say the only way you catch capitulation is if news kicks it off, and that kicks you into the trade, and then it happens to just capitulate from there, almost like capitulation. Remember in 2008 when they failed to pass the TARP? That was
Yeah.
timing of capitulation type of selling, but that was news that kicked it. When you come out of nowhere like that, you played it right. You played it right by just waiting for kind of a failure of new lows and up we can go because there's less sellers in the book. So it wasn't just you, and that's the other thing is if you're the only one trying to buy it in that chop before it capitulated, it would have worked if it was less people doing it, but there were too many of people with the same idea, and fighting
Yeah.
each other to get long, stay long, take a little bit, buy it, try to sell it, and then finally they just got murdered. Probably couldn't even get out where they even thought they could manage it. But so that was it. When was that, Woj? What was the date on that?
That was the 7th. Yeah. This was last Thursday before unemployment.
Did you trade it as an outright or did you spread into it, leg into it?
My spread was basically an outright because I had. So in spreads, you can adjust your ratios to be more aggressive in the direction of the trend you want to be, and that's what I did.
Got it. Got it.
Um, it just helps you. stay in for longer. You might make even less, but the concept is because I'm making less, I'm risking less also.
Well, I like the way you put it. You smooth out the volatility of kind of the emotion that you have. I said something that sometimes makes sense, even, I mean, clicks for me. And you're not always trading the market, you're trading yourself. You know,
Right.
market's telling you it's either nothing is going on or don't be bullish, but you're so stubborn in why it should go up that you're just trading your ego, and that's when it gets dangerous.
Yeah, exactly. Same thing happened Friday morning when you can see the continuation of Thursday, this big move into Thursday. Now we're coming into Friday morning, and at 1 o'clock, we have a pretty, this is a pretty decent sized continuation off those lows. I had positioned myself since the start of 1 o'clock European time or our time for the start of the boom when they open that we're going to get a nice continuation. Everybody's probably flat and they're not too worried about the unemployment report right now. And any kind of a downtick in the unemployment reports is going to send these bonds even higher. So going into this move right here, I'm doing the same thing as I did down here. I'm getting really long. I'm getting some really long spread positions, and I'm taking a lot of heat. And around 7 o'clock, it's actually at 5 o'clock. Oh yes, 6:30, 5:30. Yeah, they do it again. They get everybody that has this position, this bullish position to puke, and they did it with thin size too. I mean, it was really scary. And at this position, at this time right here, I thought this is such BS that they did it. They're doing it again. That I took a position in front of the number, which is what I rarely do this. But I thought if the number comes in line or a little better than expected, how far are they going to sell this? I mean, we're already. I think the bond market was down like 8 or 9 handles since that Rick's betting comment. So if I lose money, I'm going to lose. It'll be good money that I lose, but it's worth the risk because if I'm right, I'm going to make 3 times more than I'm going to lose if I'm wrong. And the number came in just barely under expectations, and I was able to actually ride this all the way into like the end of the day. Yeah, around noon.
Did you
And I added to the position as we were rallying. I kept adding
did you
to
get
it.
better at adding when you started spreading?
Yeah, because as an outright trader, I was a one-clip monkey. You know what I mean?
Right.
I didn't like if I wanted to get long and the price is let's say the pullback is at 10, so it's an uptrend to from 7 to 20 and it pulls back to 10. I mean, I'm buying 100 bonds at 10, and if it goes at 8 or 9, I'm puking it. I
Right.
wasn't very good. Oh, I'm going to average in from 12s, 11s, 10s, 9s. I wasn't very good at that. I didn't get that concept until way later in my career. Um, so yeah, and if I had 100 on and it went bid, I didn't touch it. I would have just let it go. Where even if I could have bought it, another 100 or 200, it was just it was my Achilles.
Yeah, well, mine too. I don't. You add to winners. It sometimes, if you're wrong on your ad, it messes with the whole trade. So you got to be disciplined and good with your directional call to add to winners. And if you're going to add an average, it's got to be a highly disciplined strategy also because it has to be part of the trade. So you're going to buy 12s, 11, 10s, and maybe puke 8s, but you're not buying 12s and then 10s because the 12s didn't work. It was all part of the area you wanted to defend and buy, and it's a sometimes it's a whole nother style of trading altogether. You still got to value price and look for drivers and everything, but um,
Here's where I added. I could show you. So this this is the move that happened on the number, okay? And you can see how much more we tailed. We rallied all the way up to here, pulled back. And as soon as that happens, as soon as a nice pullback happens, I did this as an outright guy, so I still do this as a spreader. I already had a position on, and this is where I added. I went actually twice as big as my original position, and it started to go against me. You can see this tail lower. And just because of where the market had been, so we're so much lower on a daily basis, I wasn't worried at all that I was taking heat on this add-on. That's where spreads have helped me out. Now, I was talking to another guy who was an outright guy, and I think he threw his calculator over my head. You know, he was so pissed off that he was wrong in his position. I'm like, you know, stay steady. You know, you don't have to freak out on this. Maybe it'll even give. If it got into this area, I would probably put more of it on, just because you're getting into territory of where we've already been. So that kind of give me some kind of support.
Yeah, right.
Um, any prior,
And I
price
like
action.
swing highs as support. You got that swing high right there that it kind of dug into around 24 and rallied out of. But 24, 24 half. You guys got to remember it's the 10-year note, so they're trading in half ticks. That's a full point rally from after the number, almost a full point, right? From
Yeah,
127.08 to the upper oh 05s, 128.05s. That's a 60 tick 10-year move. Um,
that's $1,000 for every one contract you have on.
yeah, a full point move.
Yeah,
Yeah.
and you got a couple hundred spreads on. I mean, now remember, spreads are cut in half. You make a handle on one, you're losing. You could lose a handle on the other because just the way the
It
spread is.
allows you to, I mean, again, you said it the best. It just smooths out the volatility to allow you to hang in a directional call and find better locations. There is such a bad thing as a bad location in any style or spread or outright. It allows you to hang in a good location, not to get shook out by what the short term guys are jerking around and doing. Today, the bonds were real weak. Is there any singular reason for that?
Yeah. Oh, the bonds are real weak. Exactly. I don't know what caused this, so let's just go to today real quick because this is pretty interesting. I totally misplayed this trade. So this Fed governor, so here we are in tenure and the Boone. The Boone opens up at 1 o'clock, and at 2 o'clock, right on 2 o'clock, right when the cash market opens, Kaur is a Fed governor in the ECB. Comes out and he says we're going to do serious QE for June and July, and it's going to be front loaded. And he says we have no problem taking even more negative. I mean, I had such a boner for this market to go higher. I couldn't believe they just stalled out and quit going up. On the flip side of that, if they would have said that we're not going to do as much QE and we were on the high side, you would have seen days and days and days of selling. So I don't know why we in the boom here, we kind of rolled over a little bit, and then I was buying all through here, trying to get it. I mean, I just finally gave up. I said, this is not working out.
Were you buying bone or
Because
buying
we
notes?
had a stronger than expected housing market number at 730. So it was like one of the strongest numbers since '07 or something like that. Um, Fed Evans said something not last night but on Monday night that there still is a possibility of a QE or of a rate hike in the June meeting. So I don't think there's any chance. I think the chance is still zero in my opinion, but the front end of the Treasury market is definitely flatter. They're selling the front end. They're not selling as many in the long end. But that's why we got on the left chart here this big sell-off. So you can see the big move happened right at 7:30.
Did what was I going to say? that comment was then repeated, and they actually, what the hell time? It was one of the better uh, trades that I didn't take, but one of the better trades because it rallied the DAX and Euro stocks. And they repeated that comment by one of the ECB officials about QE3 going. I think it might have been um, something all the way through 2016,
Yeah,
September of 16.
September 2016.
Right. That the DAX Eurostox caught a bid and it drove us up from like 25 to 27 even, which today was a pretty good move in the S&P. But um, what I hammer home on people, and we get it more often than not. You just got to look for it. Is what's driving this? If it's something like corporate issuance that has dried up, or if it's something like just another market, you know, the best homework you could do is finding drivers in creating logic of what's going on, or finding a location to verify or hook your trade onto that opinion, right? And that it's it's not where a market's going, it's when. Just tell me when, and I don't care where it's going. Just the little turns, and then we could trade from the right side of the market instead of being underwater. And that's what's kind of most important is this market relationship concept. And as you know, spreads make that front and center, right? I mean, that's relationship 101, as black and white as you could get.
Yeah, it's as tight as it can get. We have five markets to spread into, from the 2 year, 3 year, five, all the way out of the ultra bond. So there's plenty of room. There's plenty of ways to get into this concept of spreading your yield curve. Anybody just trading flat out S&Ps against anything, if you're struggling, I mean, start reading into it, because if we have some kind of a rate hike environment, or rate hikes are not going to happen, treasuries are going to be the place to go. And you think treasuries are lame and boring? Well, look at the moves for the last 2 weeks. They eclipsed the S&Ps.
No, there's no doubt.
I mean,
FOMC
it's
minutes
30, it's 31 and a quarter a tick. I mean, it's a juicy tick.
and the bonds had a nice bounce. They had a nice bounce, and then they tried to attack the lows. They failed and rallied. They'll slow down, but once they move, they're readable. They are. I mean, as long as they're moving. And today, I think they had a 2 point range.
Yes, it's huge. I mean,
Yeah, big ticks with nice liquidity. It's not as liquid as the 10-year, obviously, but it's liquid at 31 quarter tick.
right.
It's got decent size, and just look at a footprint of it. You see thousands of contracts at almost every price. So they it's a treasuries. I've always said, Woj, is they're truer markets because they have one underlying cash, and that's their cash, whereas stocks have S&P's got 500 companies that influence it. The Nasdaq's got 100 companies that influence it. Whereas treasuries, I know there's other things that influence it than that just its underlying cash, but it's truer, than a lot of retail influence that the ES has in
Yeah,
it.
I agree 100% with that. A nice, easy way to look at treasuries, or to break into it, would be to look at the long bond and well, you can look at the 10-year, the 30-year, and the long bond, the ultra bond. Those three right there are moving so much that even if it's slow, you can find things to do in the ultra bond. And if you have CQG or something, you can plug in the ratios to see, like, if I buy this and it goes against me, I can go to the bonds, or I can go to the 10-year, and not during the day. I wouldn't trade this. I wouldn't trade this market from 7 a.m. Chicago time till 2 p.m. Chicago time. But after so for 2 hours, even into the evening sessions, you can pick up some pretty good money in that. And the opportunity is, you can see something coming into the ultra bond, and you can make a couple ticks if you pick it up, or you can spread it and wait until what the spread you put on adjusts, and then you can take off both legs for not as much money if you were just right outright, but it might be some pretty good money because you have a bigger position on now than you would with just an outright.
Hey, FOMC minutes tomorrow.
Yeah,
I think that could inject some volatility and gain a little more insight into what they're going to do in June. Do you agree?
yeah, I think it's going to be highly scrutinized as far as how are they voting and what did they really say as far as weakness in the economy, dollar strength, what are they worried about? And if they give any hint that they're not worried about the dollar strength, then that gives them more ammo to hike rates. If they're not worried about inflation, they can hike rates earlier. If they're not worried about Greece or what the boom's doing. I mean, I really think the boom sell-off helped their cause to, hike rates. I
Did
mean,
they
the boom went from 5 basis points to 60 basis points in a matter of 2 weeks. It's just insane.
What's the after the FOMC, then they roll, then they'll get into rolling right towards the month end,
Yeah,
roll into
if
Sep.
you guys do trade treasuries or looking at it, don't trade it next week.
It's
The
a whole
roll,
specialized strategy.
roll will destroy you.
Last time you spoke was about a month ago, and we had some of the slowest treasury markets, and then that turned a week after you came on with all of
Right.
what you're going through. You were growing your size. Did you quickly cut it back to normal size and adjust?
No, actually, I kept the size because
Nice.
the trade actually fit the style. I wasn't losing money. So my first thought was this is the first time I've seen any volatility. I'm going to, see if this market can absorb what I'm putting on, and it did. I actually pushed the size as the market was getting into a more volatile cycle. I went from, let's say, if I put, when it was really slow, I was putting on 90 fights on a tick. That's pretty good money. You can make 1,800 bucks on it. I went from 90 to 160 really fast. I actually made a lot more money because I pushed my size and I was making more ticks because of the volatility. So had I lost money on my 90 fight, my original fight positions, I would have definitely cut back.
That's
It
to
was just
put
a process. It was just I'm gonna keep the same size, and if I get whacked, I'll cut it and see where I can make it back. But
and in spreads. It's a lot easier to grow your size, wouldn't you say? It becomes just a number because you're able to spread the risk.
yeah, I mean, because you don't have to be so perfect. If your spreads are right, if you're correct in the idea of what you want to do in terms of your spread, I mean, until you get to like some pretty big units, you don't have to really worry about it. It's all psychological in the sense of are you putting on the right things? Are you thinking the kid next to me? He's not seeing it right. He's getting beat up. He's frustrated. He's putting on bad spreads, and you look at him and you think, God, just what are you doing? Relax and get a better feel for the market. It's
It's hard to
it's
see
all
that.
mental, man.
Yeah, you're on the outside. When that's why it's helpful to be around others who are like-minded to get that guy next to you out of being a guy from the outside looking in to reset them, right? And
Right.
they can't. Nobody has the reset button when they're all alone. Usually, they never get consistent all alone, but they don't stay consistent because no matter how great of a trader you are or become, you go into a rut. How quick do you get out of it? Having others around you that are also traders get you out of it quicker because they say, "Hey, what's the matter with you? Don't you see this, that?" And it just stands you up and allows you to see what matters instead of just letting it spiral out of control because it is a business that brings you to your knees. So you need that support around you. That's what I'm creating a lot with this Woj is guys having more contact with not other traders, but like-minded traders that learn the business the right way, and it's
Yeah.
pretty
It's
powerful.
I don't think you could do it without it.
Yeah, I couldn't have. I went from not making money in the Dow pit to making money day one at DE. And I know you did too. And it was because we were in front of markets. We knew how to trade, or we knew a lot more how to trade than being brand new because we come from the floor. But now we were in front of markets that were opportunistic, and we knew how to exploit an edge. There's always an edge. You got to exploit it, though. You got to know it, follow it, take your foot off the gas when you should. And, well, you said something, Woj, earlier in this conversation about you made money by not losing money. And
Yeah, had I been wrong, I mean, I would have had to have cut my size. But
Bob's got a
um,
question here, Woj. Maybe you could tackle it. He says, um, would you consider taking the time to go through the mechanics of how you would spread the E-minis? If you were to, let's forget about trading and spreading treasuries. Let's say spreading the E-minis. What's your take on that? Would you do it against other indexes? E-minis versus the Euro stocks? E-minis versus the NASDAQ? Or wouldn't even look into spreading equities?
yeah, spreading equities is fine. We actually have a mutual friend, Scotty G. His best friend spreads European equity indices. He does DAX, Euro stocks, the CAC, and the FTSE. I don't think he does too many in the U.S. indices. I don't know why. He's really like closed lip about it. He's kind of like guarded about what he says, but I know that's what he does. I would start there, and the first thing you got to do is you got to find indices that have high correlation ratios. The only way to do that is to run, I guess, some vol regressions on those indices. You could do that in CQG just by, I guess, pulling up a daily chart of each of them, writing down the highs and lows of the average in each one. Then you can kind of break down and say, okay, this one's 8 out of 10 days of moving up together. This one has 5 out of 10 days moving together, and you got to do a little bit of homework to find out which markets are moving together.
The higher the correlation, the better.
You definitely want the highest correlation. When I was trading with Anthony, the DAX stocks had an 80% correlation ratio. So I was trading the FTSE that had like a 40% correlation ratio to both of those. I quit trading the FTSE as soon as I discovered or found that out. I started trading the Euro stocks and the DAX, and I had a lot of success because I wasn't actually able to spread them. I was keying off them. So back then was a lot different. I didn't have to spread. One went up, one led the way up, and the other one followed. I mean, it was really easy. Now that might not be as easy. So you would have to take the time to figure out which ones have high correlation and then get your ratios lined up. The first thing is what are the high correlating markets, and then what are the ratios that you want to be trading on them. The only way you're going to find that is to do regression analysis from Bloomberg. If you have a buddy that has a terminal or I have access to that. I can run some numbers for you and get you the highest correlated indices from the U.S. and European stock markets, and then I'll try and find you the ratios that you should use to them.
That's just the correlation matrix that the other Scott used to pump out, right?
Yeah,
And that was on Bloomberg that he found those, and they ran it from last 5 days, last 20 days, right? Last 60 days.
right, exactly. Yeah, same concept. I'll have that done, and I'll get that to Anthony, and you can start taking a look at it. First thing you do is you plug it into a chart and see what it looks like after you get if the DAX and the Euro stocks are the highest correlated, then what are the ratios? You plug that in. I can kind of help you set that up if you want to just look at it as a absolute value instead of net change. This is a concept of so like right now what is it? The net change on the Euro stocks is is what I have that highlighted or down.
Yeah, no, I
You know,
think that
you take the net change of the Euro stocks, you take the net change of the DAX, you put it in the formula, and it pumps out like, okay, this is 5 strong, this is 5 weak, or whatever it is, and then you kind of get a concept of every time it gets to be X strong or X weak, this is a great time to fade it. I mean,
so. It's like overbought, oversold.
exactly.
When you say 5 plus, 5 minus, what do you mean?
That's the net change formula for the two indices.
Ah, I got it. And that's
So
the
like the
reversion
knob
back.
right now, so like the knob right now, 10-year notes over the bond market, the knob is printing, 4.5 cheap, 4.5 weak. That means the 10-year note is cheaper to the bond based on these ratios I use. And the nice thing about using it in net change is because I don't look at it in absolute value and get kind of like into the numbers of what it actually is. What I mean by that is, let's say, for example, I know the knob has been very, very strong over the last 45 days. How do I buy that? How do I sell it? Where am I selling a top, and how am I buying something that's very strong? Well, I'm stripping out price. I know that it's very strong, and that's in the back of my mind. But if it's 2 or 3 cheap, and I know it's near the high of a 45-day move, every day it goes up, I can buy this safely at these prices and maybe make a tick or two. Where if I looked at it and said it's 14,822 and it's 3 prices away from new highs, I might be scared to buy those just because of the concept of absolute price
Got it.
versus change on the
It's
day.
I
So net
like that.
change is like how many ticks up or down is it on the day.
I
And
like
then you
that.
write your formula out and you kind of it strips out price, and that's what I like.
That's I pull out. That's one of the goals I had for this year, and I'm legging into it is to have spreads kick me into outrights, or not necessarily spread, but help me directionally predict or predict the direction, a little longer term direction, right? Because I could find if I'm more confident with where I think it's going, I'll find great places to get in. Um, it's about the confidence of direction, and I've always had it nailed of where to execute. But if I'm directionally weak, meaning I'm really not as confident where we're going. I think we're going up. I'm obviously more apt to get shook out, especially as an outright trader, and you know that feeling. And you're dead right, but the more confident you are, even in that direction, you don't get shook out, whether you spread it or not. But you're looking at the spread to kind of maybe lead the outright, or at least give a sense of you have other reasons why we're cheap. And now that the ES should get strong against its peers, right? And that
Yeah, the best time I like to just trade, off a net change is when there isn't any fundamental news, because that gives me a better sense of, okay, this is out of line, and odds are over time, and it could take hours for this thing to go from 2 or 3 cheap to at least back to unchanged. That's how I trade spreads when there's no fundamental news. I mean, you
and that's
can
important because if there's fundamental news, that could be the reason for it being
exactly,
cheaper.
exactly.
Right.
So the guys that are getting run over in my office because all they're doing is fading a spread, fading a net change spread. If they're buying, knobs, 2 or 3 cheap, I don't care if they get good. I don't care if he buys them, the kid next to me buys them 3 cheap and they go to unch. I don't care. That's not the risk I was willing to take. I wanted them a lot cheaper. Or I'll even sell them at unchanged now that they got good for him, but knowing fundamentally that they could get cheaper than where they were, I'll take a shot and just sell them. I call that in a hole or at a bad spread level. I'll sell them at unchanged, and I'd say 9 out of 10 times. I mean, if it is fundamentally based, those spreads are going a lot cheaper than 2 or 3.
Plus, you got guys like him that got to cover,
Right, right. Yeah,
and they
exactly.
gotta sell. They gotta puke at some point that long position they bought. from a price that they might even have some money into. But
Right.
the I would imagine. So Scott G, do you still talk to him
Yeah, once in
or
a while. I just reached out to him a little while ago. He's trading stocks. Like
Euro stocks or
no, just
individuals?
individual stocks. He's retired, so he's got a lot of time to look for value stocks with um, dividends or buybacks coming online. I think he's doing better now than he did on the floor.
No kidding. And he
That's
did
just
great on the
crazy.
floor.
He's doing really well. Sitting, waiting. He's got his little heat map of stocks that he's watching, and he waits until they get to a certain level before he buys them, and he might hold them for 6 months, or he might not trade for weeks at a time.
Yeah. Now Scotty's a good. He was a good trader as long as he found his niche. He found his little niche and he exploited it. Scotty's an older guy than us, who was a big grain trader, and then was a friend of the guy who owned the prop firm we started at. He traded some electronic, but then he went back to the floor and ran his grain operation until that kind of fizzled out because of everything, all the high frequency stuff that got introduced to that market. And now he's done well enough in his career; he doesn't even have to work, but he sits back and is able to trade and be patient with certain, price is price. It doesn't matter what the product is. Price attached to it, you know, go find value. Buy it cheap, sell it expensive, and then everything else seems easier. Just got to identify all the spots. So it's his friend that's trading the spreads on the
The
European equities.
European equity indices.
I know Dan. Is it Dan? Yeah, Dan R. Right? He's still with Dave.
Yeah, he is.
He's part owner, isn't
Probably.
he? he I think he traded a lot of ES. No, maybe not ES Euro stock
Yeah, he did
spread.
a lot of stocks, Euro stocks.
Right. And he was keyed off the ES obviously, but
Right.
I
He
don't know.
keyed off of all the sectors, whatever the hot sector was back in '06, '09. All he cared about were the financials, the housing,
Yeah.
whatever sector was hot. He'd build his, you know, charts out and key off of those sectors.
Well, and that's what I keep getting back to people listening to this live or listening to it. Everything is always based on relationships. That's where your edge is. Period. And if that isn't a big part of how you're trying to value price, then you're just an outlier to everybody. Hopefully, as you're listening, that have done it and do it. It's all relationship based. All these systems, high frequency stuff, that's relationship too. If they're front running, what are they? It's cause and effect to another big order, right? And they're just seeing a relationship and putting something else in line, whether it's in a predatory sense or not. That's where your edge is. Edge is always in seeing something that's out of line, and you always have a lot of people that are late, are retail, or funds that really don't care. They'll give up some ticks, right? And keep selling it at a certain price and let the little guys pick a little bit from the bone. And that's you could be a big guy and pick from the bone is what I'm saying. Woj and I have been around a long time to do it and see it throughout the different traders we've come across and been with. So FOMC should be important tomorrow, could be important, and then the rollover where you kind of get standoffish the way you trade the spreads, right, until they expire the June and roll into the SEP.
Yeah, I'm actually gonna lay off all spreading next week, and I'm gonna try and get where I'm at. These guys do a lot of spreaders, a lot of spreading in the roll, and they're really good at it. They're old floor guys, and uh, the idea was some guys made their year in 2 weeks time, 4 times a year, three
That's all
times
they
a
would
year.
come. There would be guys that came to the floor for 2 weeks every quarter, and that would be it. That was their Those were their hours. Last 2 weeks of March, or not March, February, May, and then two more times ahead of probably August, right? And
Yeah.
November. They trade the
So I'm
rolls.
going to try and do that. I'm going to try and get into some roll spreading, see if I can wrap my head around that.
Are these guys that are with your firm?
Yeah.
Okay. Well,
This
that's
is
good.
all, I mean, everybody does it there except me. Just never did it before. Pretty stupid.
And when you get into it, you'll be mad that you didn't do it 2 years ago, right?
I hope I am.
Yeah. Well, that's it. I remember when I finally started
If
trading
it's good,
bonds.
I mean, I would love to be pissed off that I didn't do it sooner.
Yeah, it's a good problem and feeling to have. I felt like that uh, when I didn't trade, or when I finally went in trading bonds. I can't remember what year, but it was a better market to be in back then. So you just gotta, and that's about being around other people too, to make you aware to look at this or look at that. And so Woj kind of taking advantage of it. Well, there's another thing I had that I wanted to ask you. Um, so you'll get me that matrix though, just attachment and email.
Some correlation studies?
Yeah, I mean, even if it's just a matrix, that correlation matrix that
Yeah,
you put out
I'll put together something for you guys.
on the equity side.
I think it'll help you.
Yeah, it will. Especially we'll be able to chart it and see what it shows us. It's essentially another product to relate. Is there anybody got any direct or any other questions for Woj before we wrap it up? Tom asks, when does a capitulation become a crash, become a correction? Uh,
Well, capitulation usually happens in a short amount of time. You can look at this and say, let's go back here. Capitulation usually happens when, after this entire move. I mean, this is the capitulation. You know what I mean? This is the obvious. It sold off and it rallied back. That's. I
what was
mean,
great about '08 is there was many capitulations within the correction. I mean, it was
right. The capitulation usually doesn't last longer than a few hours. Um,
sometimes a few minutes.
and you know when you're in it. I mean, you're when you're too afraid to put a position on, that's when it's.
That's a capit. Yeah, you're
Yeah.
not. You're not. You're not. You're not stuck, but you could feel the risk. It was almost like that flash crash. Nobody knew.
That was totally it. Yeah, I mean, when the order markets are just completely, you know, untradeable, people are blowing up, either to the upside or the downside. They capitulate
Were
off of
you
fear.
Were you in California when you in '08 trading out of
Yeah,
that office in California?
yeah, we were out there.
But you didn't have any kind of latency or any kind of everything seemed the same speed out there, didn't it?
Yeah, we paid for some pretty good speed, and this was, a while ago. Now you can probably go trade in Alaska and it would be fine without any latency. We were co-located. Our servers were in the Equinox building, so that was, if we were working orders, we didn't have to worry about them sitting on our trading box in San Diego to get filled in Chicago and then show me the fill back to San Diego.
This question could be for me as much as you. Are you watching to get your directional opinions in these spreads, other than just solid fundamentals? You watching anything with the VIX? Obviously, you are with the cash markets. Any kind of volume profiling of the outrights or even the spreads?
One guy is going to show me some stuff on a volume based hits and lifts, um, but that really doesn't that's really spreads take so much time to develop that the microchasm of when to get in because a big order came through is almost irrelevant. The only thing I look at, are simple spreads. I mean, I have a million spreads up, and I just want to see old support levels. You can see I don't have one single, you know, trading tool on my screens on any of them.
Yeah, no, that's good. And so you're just looking, but you have to, you've,
Let me give you guys an example of what I was talking about as far as like, so this is a knob spread. I mean, this is a 60 tick move since the 13th of June. I mean, that's an insane amount of movement in this thing. Now, if this was in price versus net change, you can see how this is a net change. This might say like 4,670. Well, I really don't know what that is. I don't know what a tick is. This is a tick. This is a tick. I could see that physically, like, and mentally, like, okay, if I buy this, I know I'm buying the high, but it could be like too cheap on the day. I can buy it too cheap on a day, and be right at some point. In absolute price, I might not be able to, wrap my head around buying something so strong after so many days of being so bullish.
now my answer to this question is because I'm trading the outrights, Bruce. Yeah, I'm not watching the VIX directly. I'm not watching the cash, but I'm watching ancillary markets because I'm looking to be less patient. And with outrights, everyone's got a different take on it and different patient levels and different risk tolerance. So, a lot of risk to me is different than a lot of risk to you, maybe. But that area is what you want to stamp out of where to get long. And correlated markets such as like today, the best place to find it to get back up, fight it back to the open in the S&P was when the Euro Stocks and DAX led it because you bought it and it absolutely went straight up. So those are main markets for me. But when you're trading, yeah, so when you're trading, some people call them pairs. When you're spreading, the best the best thing that I thought was said. Did you just stop sharing your screen?
No,
Okay.
something happened.
No, that was on my end. Um, the best way that I've heard it said was from Woj, I think a few months ago, was it smooths out volatility and does essentially remove your sensitivity to time. Right, Woj?
Yeah, the biggest problem with spreading is once you're in a spread, it might not get better for hours, and it's frustrating. It's like, it's almost on the verge of proving you wrong a lot of times, and you just have to stay, you have to stay in it until it does prove you wrong. And it's the tough part about it.
There
You
was a
have to.
guy a long time ago who said that you're supposed to add in spreading, like opposite. You shouldn't add losers in outrights. Do you
If
agree
your
with that?
concepts are right, if your theory is sound, if you have a fundamental belief or a technical belief, yeah, you should add to losers. It's the way when a spread gets pushed out, it's the way to really capture when it retraces. It's
Back
the
into
way
value?
to really put it to them.
Yeah, I had that as a goal this year is to focus on the um, the spread side of things, not the spread, to focus to see what the spreads between the outrights I watch might show me as a way to smooth out small hiccups, give me more confident. You always want more confident directional calls, right? I mean, the
Right.
best thing would be to get the news early. That would be pretty confident directional play you could put on. So that's that'll create less shakeouts and ability to trade bigger. And you make more money by just trading slightly bigger.
Yeah, everything I did, over the last 2 weeks was based on, because I'm trading at night. What is the boom doing at 1 o'clock? Where did we come from 5 p.m. to, we open at 5 p.m. what did we do in Asia? There's usually not too much news or anything to like really get us flowing around. If we had a big sell-off that day at 5 o'clock, do we retrace some of that sell-off? If we do, that's great because now I want to see what happens when the boon opens up. So then we get kind of a first look at 1 o'clock, and then at 2 a.m. is when the real fireworks show. That's the main event. And if I had a couple positions on and the boon continued to be directionally good for my positions, then it was great. And if it wasn't, I mean, I get out of it. Um, that's where knowing what direction, uh, knowing what risks and direction to your spreads will do to you. I mean, if you're long knobs and the boon turns around, well, is that going to be better for my knobs or worse for my knobs? And that's where 5 years of spreading treasuries only has given me an advantage to the guy next to me who's scratching his head all the time.
Was he brand new?
He's new. He's not new. That's the problem. He never took the time to really get into the fundamental side of why these markets move.
How does he do?
He's okay. He can make a living. I mean, for what he makes, it's really not worth the stress. I mean, you got to make some good money to do this. It's just.
Well, that's it, and especially the heat that some of these guys take. The guy, well, there's a lot of stories that we could tell with the stress level and the level, or the not the stress level, just the noise. With when we moved offices, we actually had a loud room and a quiet room created. Remember that?
Yeah.
And because some guys didn't care, some guys did, and so they actually structured the office from that. One thing that's funny is that, and I didn't realize this, but 95% plus don't know what a prop firm is. People out there,
Oh,
and
for sure.
yeah, I didn't know that. I'm like, well, it makes sense because I didn't know what a prop firm was in 1999, even though I was on the floor. I didn't realize that kind of business model existed until, I found out that it
He
did.
did. It was just more like your uncle's a trader and he's gonna back you.
Right,
Well, it
that
grew
was
from
it.
that,
Yeah,
grew into like a small brokerage group was going to take on a new guy every 6 months, and if he's got any kind of brains, they'll put him on a badge and they'll back him. Then it really started to take off when it went electronic, when you can have offices and you can get CQG and you can get tools to help us trade even better.
and
That's
you could leverage all that, and
Then you can leverage your
yeah,
office with 20 guys. If 3 guys made money, that paid for the entire office.
right. And then you had time with the other 17 to develop, plus the education, and whether it was structured education or impromptu stuff. Some of the things that I learned the most were something said from desk to desk, just in a live environment where one thing I remember Dave saying was when we rally and the best trades he has is listening to guys pound their desk. He knows they're stuck long because the boon won't rally anymore, even though the
We
bonds
had
are.
we had a guy Joey who was the best indicator ever, or JT. We
Sometimes
worked on him.
the more
Yeah.
mad they got, the more money they were making. When they got quiet is when you had to worry about them. No, but that's it. And then there was, again, it just goes back to the edge being, pairing off, relating it to something else. And you don't have to be a genius. In fact, too much knowledge is bad. You start to
Right.
outthink yourself and think that you're never going to be wrong. Being wrong is good.
Oops.
Let me take the screen back a second. Oh, wait a second. Let me do this. 1 second, Woj. Hang tight. hold on. Let me see here. 1 second. All right. You still there?
Yeah.
Yeah, I can't pull up my thing here. That's all right. When's the Fed funds got it baked in for the first first hike?
The probability is in September.
September. So that's not June. Then there's probably a late July meeting. There's 2 meetings in the summer.
Yeah, and then there's not one in August, so then it's September.
All right. So there's not the next 2 meetings, but the third one.
Right.
Probability, right? Sounds good. But June could be something that shakes things up, both on the Treasury and equity side. Not just.
Yeah, maybe we'll wrap before then, and if I have anything to add on that, that's when we can go over it.
That's a good idea because that's late June.
I think so. I don't even have any numbers up. But if
Yeah,
I'm around, I'll text you. I'll let you know. Like, let's schedule something on Tuesday. On Tuesday, it'll be before the meeting, and we could just have like a 15, 20-minute review of what's expected and what I think should happen if X is said.
that's perfect. Well, thanks again for stopping by. We'll.
Yeah, no problem. Hope some of it helped.
No, it did, and you know what?
Just
Even with me, I like just there are things that listen. The conversation we had a few months ago, watching the short end leading, could either make you money or save you money. But all these things help. I'm sure a lot of people are thanking you in the chat box as it comes across, but we
that's right.
appreciate it.
The thing that's leading right now is that Boone. I mean, if you guys are trading, fixed income or European bonds or European equities, watch that. Watch the Boone and the Bobble. I mean, it's leading the entire uh, complex right now.
Sounds good. All right, well,
All right,
thanks again, man.
guys. Good luck.
Thanks.
See you.